The coming months will likely see the biggest drops ever recorded in Australian house price history. And in the last 10 days, all four of our major banks have come out and reported the exact same concerning thing. Something that they've never all reported at the same time before, not during the global financial crisis, not during COVID, not during the recession that we had to have in the 90s. And yet not that many people seem to be talking about it. So what have CBA, ANZ, NAB, and Westpac all reported that's gotten them so concerned? And given their concern, should you be concerned? Is now the time to be making a move in the property market, or is it better to wait it out? Hi, my name's Jono, and I've been part of nearly 1,000 property purchases over the last decade, and I've never seen all four major banks at the same time report such concerning numbers. So in this video, let's go through what they all reported, why it matters to you if you're thinking of buying, and what is going to happen next. So the big four banks account for around 80% of Australian mortgages, and what they've all said in the last 10 days is that new mortgage applications are dropping very fast. ANZ have reported a 12% drop, NAB pretty similar, Westpac around 20%, and CBA 15%. Now, most of these falls have come from the investor segment. So CBA's fall, for example, was 28% investors and only 9% owner-occupiers. And in response to this, we're seeing some creative solutions. So AMP have just launched a 40-year loan. NAB have actually cut owner-occupier rates, even though the RBA, of course, have kept things on hold. Westpac is offering a 95% loan for investors, and it also has another loan product that has a 15-year interest-only portion. And these will probably be replicated across all of the big four or something similar soon as the banks look for ways, creative ways to grow their loan books now that their loan applications are falling. But for you, if you're a mortgage holder, the opportunity here is to ring your bank and ask them to do a rate review, because they're never going to be more receptive than they are right now to giving you the most competitive rates. You may be able to save yourself a few $100s a month by making a simple phone call. But the bigger question is probably, will falling loan applications lead to falling house prices? And the answer is, well, probably yes, a little bit, because ultimately falling loan applications are a reflection of falling demand. But for prices to really fall, you also need distressed selling and lots of supply. So let's look at supply. And you can see from the latest Cotality report that current listings nationwide are around 135,000. So to put that in context, that's around 1.2% listings nationally, which is still very low. Historically, a balanced market is considered to be between 2 to 3% of listings. So to be at 1.2 is still nowhere near. Now active listings are up, and part of that is because listings are taking longer to sell. You can see the days on market is up to around 36 nationally, down from a year ago. 36 is still very, very quick to sell a property. A balanced market is around 50 days. So although broadly the trends are pointing towards greater price falls nationally, we're certainly nowhere near the level of supplies that's going to give us a crash. So for us to have the greatest housing crash in Australian history, we need to drop by around 8%, which is, I think, very likely from here. But for most capital cities, if we dropped by even 15 to 20%, this would take us back to like mid-2025 levels, which is, when you put it like that, hardly that dramatic. And if you look into the structural debt levels of the Australian housing market, you can see why we're just never going to have the kind of crash that some people are hoping for. There are approximately 11.5 million properties in Australia, and those 11.5 million properties are worth roughly nearly $13 trillion. Now, of that $13 trillion, approximately $3.5 trillion is debt, which is to households, and then you've got maybe another 300 or 400 billion that is to companies and trusts. Let's say close to $4 trillion worth of debt against 13 trillion of total housing value. So you're sitting around that sort of 30% of debt to total value. Now, of those mortgage holders that do have debt, which is roughly around 3.5 million households. Now, based on a March 2026 RBA study, if house prices fell by 40%, then 80% of those mortgage holders would still be in positive equity territory. So to recap, approximately Australia's loan to value ratio is 30%, and of that 30% of loans, roughly 20% would be impacted if there was a 40% price decline. So a 20% impact on a 30% group would be, you're talking about 6% of the total market would be impacted if you had a 40% correction. But to get to a 40% price crash, obviously you'd need lots of supply and distress selling to get there. So we're just so far away from having the kind of crash that some people and some news articles are reporting we're headed to. So should you wait then? Well, probably not, because in supply constrained markets where sales volumes are low, as they are, and they're slowing, the price falls can be very dramatic, because when you do have sales, they are typically going to be lower because the people selling are motivated to sell. So every sale has a greater influence on the average price because there's so few of them, and it drags that average down faster. Just in the same way that in a supply constrained market where people are buying a lot, the prices move up faster. The problem with Australian housing's inaccessibility and affordability is the structural undersupply. We brought in 300,000 people last year and built 175,000 houses in a market that's been behind for the last half a decade, and it's just not enough. So when interest rates cut, or there is a shift in sentiment sometime maybe next year, then the prices will reverse really quickly because of the structural undersupply and the limited number of properties actually selling. So by the time it's reported and the media has got hold of it, it'll probably be too late. And of course, up until this point, we've been talking about aggregate demand and supply on a nationwide level. There are roughly 500 suburbs in Australia that grew at a pace of nearly 1% last month and are on track to do double digits over the next 12 months. There are always going to be some markets that perform whilst the average house price goes backwards, just like there was in the last downturn in 2008. So in these markets, you're going to have even better opportunities as you're making money now, and it will only accelerate further once broader confidence returns to the market and the kind of mum and dad investors re-enter, as well as competing with more owner occupiers. So I'm about to go on the biggest buying spree I've ever undertaken over the next few months. Be fearful when others are greedy, and greedy when others are fearful. Now is your window. If you need any help, reach out. Contact details are in the bio.